Q2 net sales grew 9% year over year on a constant currency basis, hitting 4.815 billion euros, and comparable diluted EPS came in at a solid 7 cents.
But, and here's the kicker, the reported diluted EPS was absolutely flat. I mean, literally zero?
Right, zero. And the margins are just as chaotic, honestly. Comparable gross margin expanded 70 basis points to 46.0%.
Yeah, and comparable operating margin went up 70 basis points to 9.0%.
Which sounds great, right? Until you look at the reported operating margin, that took a massive 430 basis point hit, dropping all the way down to negative 1.0%.
It's a cliff. And right in the middle of this, management issued a revised full-year 2026 guidance. Technically, they revised the comparable operating profit to a range of 2.1 billion to 2.6 billion euros.
So if you're a retail investor looking at these numbers in your portfolio, you are probably, trying to reconcile all this.
For sure.
It is basically the ultimate tale of two balance sheets, and that is exactly our mission for this deep dive. We are unpacking Nokia's Q2 earnings, cutting through all the accounting noise, to really understand how the company's AI pivot is impacting the bottom line.
Because you have this really healthy top-line revenue growth going head-to-head against some incredibly heavy immediate restructuring costs.
Exactly. I mean, how do we have two completely different realities existing on the exact same income statement?
Well, so when you look at those comparable numbers, the 9% revenue growth, the 9% margin, you're looking at the actual underlying health of the business operations.
The day-to-day stuff.
Right, the day-to-day selling of technology and hardware. That engine is humming along nicely.
Right.
But the reported numbers, those include all the messy, super expensive one-time accounting hits.
So it's the cost of ripping out the old foundations to build something new.
Precisely. It is the financial cost of a structural teardown.
Okay, let's actually set the teardown aside for a second, look at the engine itself. Because, I mean, a 9% top-line growth is substantial.
It really is.
To understand how they achieved that, we need to break down where the revenue is actually coming from across their primary operating segments.
Yeah, and the absolute standout performer this quarter, I mean, the segment doing all the heavy lifting, is network infrastructure.
Okay.
It grew 12% year over year on a constant currency basis. And when you look at the specific drivers under the hood there, it's pretty eye-opening.
What's driving it?
Optical networks surged by 20%, and IP networks grew by 16%.
Wow, 20%.
Yeah.
Which, makes perfect sense when you step back and look at the physical reality of the internet right now.
Yeah.
We constantly talk about the cloud and AI, like there's these ethereal software concepts floating around in the sky, but the cloud is really just millions of heavy, hot servers sitting in massive data centers.
Yeah, lots of hardware.
Right. And as hyperscalers build out these giant AI server farms, those servers have to talk to each other. They need incredibly fast, really thick physical pipes to send, petabytes of data back and forth without latency.
Exactly. You are talking about dense wavelength division multiplexing.
Which is a mouthful.
It is. But it basically just means shooting lasers through glass fibers. That's what optical and IP networks do.
Okay, so the pipes.
Right. The physical plumbing of the internet is going through this massive upgrade cycle just to handle all these AI workloads, and Nokia is the one selling the pipes.
Got it. But you have to contrast that 12% growth with their other major segment, right? Mobile infrastructure.
Yeah, the traditional cellular business, mobile infrastructure, grew 7%.
Slower, but still respectable.
Slower. Yeah, but what's really crucial here is that this segment maintained a stable year-over-year profit contribution.
Okay.
And that stability was driven by a really favorable product mix. Radio networks were up 7%, technology standards jumped 15%, and core SAFs were eked out 1% growth.
It's helpful to think of it like a stock portfolio. Or actually, let's use an automotive analogy.
Okay.
Think of Nokia right now like an automaker that makes both, commercial semi-trucks and high-end electric sports cars.
Okay, I like that.
The mobile infrastructure segment, the 5G rollout, that's the commercial truck division. It's a mature market. It's not going to double its sales overnight, but it is a steady cash cow. It provides a stable base.
Right, the reliable dividend pair.
Exactly. Meanwhile, network infrastructure is the electric sports car division. It is this high-growth tech stock essentially operating inside the company, pulling the overall average up.
And crucially, the cash flow from that mature truck division is what allows them to aggressively fund the R&D for the sports car.
Yeah.
And the catalyst driving that sports car is unequivocally the explosion in AI and cloud demand.
Right, because you don't just accidentally stumble into 20% growth in optical networks.
You certainly don't. I mean, if there's one staggering data point in this entire report, it is this Net sales to AI and cloud customers grew by 105%.
Wait, 105%.
Yes, they more than doubled their sales to this specific customer base in a single year.
That is wild.
And looking forward, they reported a 2.8 billion euro order intake in this exact space.
Okay, wait, let's stop right there and apply a little bit of skepticism.
Fair enough.
2.8 billion euros is a massive number to throw on a slide deck. But we see order intake metrics all the time in this sector. Sometimes it's rock solid, and sometimes it's just, a non-binding memo that evaporates the second the economy shifts.
Right.
Is this actual near-term cash, or is it just paper momentum?
It is a completely valid challenge, and honestly, management addressed that exact concern on the earnings call.
What did they say?
They explicitly noted that they expect around half of these orders to convert to recognized revenue over the next 12 months.
Oh, wow. Okay.
So to answer your question, yes, this is a near-term reality. Roughly 1.4 billion euros of that intake should actually hit the income statement within the next 4 quarters.
That drastically changes the math. If half of it is converting within a year, the demand is just ravenous.
Ravenous is the perfect word. In fact, management stated that right now, supply not demand is the main constraint in the industry.
Really?
Yeah, the customers are there, they have the capital, but they physically cannot get the hardware fast enough. This supply constraint is actually forcing clients to sign multi-year orders just to secure their spot in line.
That right there, that is the core aha moment of this whole deep dive. The AI revolution isn't bottlenecked by software or compute algorithms right now.
No, it's not.
It is bottlenecked by the physical reality of manufacturing hardware and laying down optical glass.
And Nokia is leaning heavily into that reality, and not just with, dumb pipes. They are integrating intelligence directly into the network layer.
Right.
The report highlighted several major strategic wins here. For instance, they secured a massive Google Cloud partnership focused specifically on AI agents.
Nice.
They're also rolling out AI-powered network slicing with Vodafone Albania.
Network slicing is so fascinating. Just to visualize it, if you imagine a standard 5G network as this massive, kind of chaotic, multi-lane highway, network slicing is basically the software's ability to instantly rope off the left lane, like dedicating it exclusively to a VIP motorcade so they never hit traffic. It lets telecoms sell guaranteed ultra-fast connection speeds to specific enterprise clients.
Exactly, like a hospital doing remote surgery or a fully automated factory. It is a massive monetization lever.
Absolutely.
But the technological leap that really stands out to me in this report is their new AI RAN product launch.
RAN being radio access network, right.
And the headline feature Nokia is pushing for this AI RAN launch is that it boasts 2x spectral efficiency.
Okay, let's unpack that, because spectral efficiency sounds like super deep engineering jargon, but it is basically the holy grail for a telecom company.
It really is.
When a telecom operator wants to expand its network capacity, they usually have to go to a government auction and spend billions to buy more raw spectrum, right?
Yeah,
because spectrum is finite real estate. So how exactly does AI double that efficiency without them having to buy more real estate?
It comes down to predictive optimization. Traditional radio networks kind of just broadcast signals in a really blunt, static way.
Which causes interference, right?
Right, signal interference and wasted bandwidth. But by putting AI at the radio access level, the network can actually analyze real-time traffic patterns. It can predict interference before it even happens, and then dynamically adjust signal strength and targeting on a millisecond basis.
So it's basically constantly solving this massive multivariable calculus problem in real time.
Exactly, just to squeeze double the data into the exact same radio wave.
That's incredible. If Nokia can sell an operator a package that gives them twice the capacity from the spectrum they already own, I mean, that saves them billions at the next auction.
Oh, the value proposition is completely undeniable.
But here's the catch. The tech is there, the demand is clearly there. But to capitalize on a super cycle like this, to physically build the optical hardware and fund that AI RAN research that requires massive amounts of capital,
Huge amounts.
how does an infrastructure company find the cash to build new manufacturing facilities without just drowning in debt?
They have to sell off their own furniture.
Right.
Which brings us to their strategy of really ruthless portfolio pruning. Nokia is making hard choices about what is core to the AI future and what is just a distraction.
What are they cutting?
Well, this quarter, they moved 2 specific businesses to a category called discontinued operations. First, they are selling their fixed wireless access, or FWA CPE business, to Inseego.
And just for clarity, CPE stands for Customer Premises Equipment. That's the physical hardware, like the routers sitting inside your house to catch the signal.
Right, it's a much lower margin, highly commoditized hardware business. That transaction is supposed to close in the fourth quarter of 2026.
Okay.
And additionally, they noted that the sale of their enterprise campus edge business is highly probable. So they're actively looking to offload that too.
And this pruning, this is exactly why they had to issue that technical revision for their full year guidance, right? The one we mentioned in the cold open, the 2.1 to 2.6 billion euro range.
That is correct. Operationally, their outlook for the core business didn't weaken at all.
It's just an accounting thing.
Yeah, standard accounting rules dictate that when you categorize a business as discontinued, you have to remove its expected profit from your forward guidance.
So it caused a technical revision, but the core engine is fine.
Exactly. It doesn't reflect a slowdown.
You know, it's kind of like a garden. You have to aggressively prune the dead or low-yielding branches like FWA and Campus Edge so the tree can direct all its nutrients into the new high-yield fruit.
The optical manufacturing and the AI tech.
Right.
And where they're deploying that capital is fascinating.
Yeah.
They are heavily concentrating on specialized optical and semiconductor manufacturing in the United States.
Oh, really? Where?
Well, they're increasing their advanced test and packaging capacity by 10x at their facility in Pennsylvania.
Wow, 10x.
Yeah. And they have their San Jose fab on track for production by the end of this year. On top of that, they agreed to acquire NXP's Chandler Semiconductor site, targeting first production for 2028.
Pennsylvania, San Jose, Chandler. That geographic concentration is definitely not a coincidence.
Not at all.
They are deliberately localizing their supply chain within the U.S. because the hyperscalers, the Microsofts, the Amazons, they want secure domestic supply lines.
Absolutely. In this geopolitical climate, they do not want their AI expansion held hostage by a trade tariff or a vulnerable shipping lane.
It's a really smart move to align with the hyperscalers' risk management. But, as we saw in the numbers up top, expanding manufacturing while tearing down other divisions comes at a steep, immediate cost.
A very steep cost.
This is where we have to talk about the ugly reality of the balance sheet, because if you don't understand the mechanics of restructuring, these numbers look terrifying.
Yeah, they do.
We mentioned the reported operating margin dropped to negative 1.0%, and we have to talk about the 800 million euro hit. What exactly is a company spending nearly €1 billion on just to restructure itself?
So Nokia accelerated its restructuring actions, which led to a massive 390 million euro charge in Q2 alone.
Just in Q2.
Just in Q2. That single charge is what dragged the reported margin into the negative. And management now expects total restructuring charges for 2026 to hit 800 million euros.
Okay, break that 800 million down for me. Where is it going?
It falls into three main buckets. First, you have the general 2023 to 2026 cost savings program. That accounts for about 250 million euros this year as they wrap it up.
Okay, standard corporate lean out stuff. What's the second bucket?
The second one is massive. They are fully integrating their China joint venture into their global operating model. They took full ownership of it in January, and they want the integration done within 2 years. That's going to cost 350 million euros by the end of 2026.
Wait, hold on. If they already took full ownership of the joint venture in January, why does it cost 350 million euros to integrate a company you already own? That sounds less like integration and more like, I don't know, corporate surgery.
Because unwinding a deeply embedded joint venture, especially in China, is incredibly complex. You're paying severance to eliminate redundant roles. You have to tear out incompatible localized IT and accounting systems and migrate them to your global standard.
That makes sense.
And most expensively, you have to untangle and reroute established supply chains to make sure you have complete control over your IP and margins.
Okay, so it's expensive, but it gives them tighter centralized control.
Exactly. It makes strategic sense.
All right, what is the third bucket?
An additional 200 million euros for new restructuring programs primarily focused on Europe. Again, just simplifying the operating model and shifting resources toward AI.
Okay, so those are accounting charges. But let's look at actual physical cash moving in and out of the bank account. Because free cash flow is basically the ultimate truth teller for a company's health.
The cash flow reality check for Q2 is sobering, to say the least.
Yeah.
When you combine those heavy restructuring outflows with a 1.15 billion euro hit from net working capital, Nokia had a negative free cash flow of 732 million euros for the quarter.
Negative 732 million. I mean, for retail investors skimming a headline, seeing a company burn three-quarters of a billion in cash in one quarter is a massive red flag.
Oh, absolutely. Your finger might hover over the sell button.
Right. So we have to unpack that 1.15 billion euro hit to net working capital. How do you lose over a billion euros to working capital?
You have to view it through the lens of their manufacturing pivot. A hit to net working capital doesn't mean the money evaporated or was lost to inefficiency.
Okay, so where is it?
In periods of massive manufacturing expansion, like scaling up 10x in PA or rushing a fab in San Jose, cash gets temporarily transformed into physical inventory.
Oh, right. Because before you can sell a finished optical component to an Amazon or Google, you have to buy the raw silicon, buy the testing equipment, hire the technicians.
Exactly. That cash leaves your bank account and basically sits on the warehouse floor as work-in-progress inventory. It is money working in the system, not money lost.
Got it.
And management highlighted this. They noted that free cash flow conversion should actually normalize to between 55% and 75% for the full year. It's just heavily backloaded, depending on when those hyperscalers actually pay their invoices in the second half.
So if the negative free cash flow is essentially a timing issue tied to inventory, does their balance sheet actually have the bedrock to absorb a 732 million euro outflow without cracking?
Unquestionably.
Yeah.
Despite the cash burn this quarter, Nokia still has a robust end-of-period net cash balance of 2.77 billion euros.
Okay, that's a lot of cushion.
And their total gross cash balance is over 5.1 billion euros. They operate with a fortress balance sheet specifically designed to absorb the shocks of a pivot like this.
All right, so if we pull all these threads together, what is the ultimate takeaway for you?
Nokia is in the middle of a highly aggressive, very expensive, but potentially transformative pivot. The top-line growth is absolutely there, driven by that 12% surge in network infrastructure. The AI order intake is booming at 105%, and their tech leads, like AI RAN, are required for the next decade of infrastructure.
But to ride this wave, an investor really has to have the stomach for the short-term reality.
They do. You have to accept that unwinding these joint ventures, pruning legacy businesses, and building out domestic U.S. manufacturing, all of that, is going to act as a heavy drag on reported earnings and free cash flow in the near term.
Right. You have to look past the noisy negative 1% reported margins and focus on the 9% comparable margin. They are trading short-term accounting pain for a long-term structural moat.
Exactly.
Which brings us back to the central aha moment of this report, and it leaves us with a final provocative thought. Management explicitly noted that supply, not demand, is the main constraint right now in AI and cloud.
Right. The physical bottleneck is the defining reality.
The hyperscalers are banging down the door with 2.8 billion euros in hand, but the industry can't build the networks fast enough. So the question is, will Nokia's aggressive capital deployment, scaling 10x in PA, rushing San Jose, buying the Chandler site, will that be enough to let them bypass these global bottlenecks?
That's the billion-dollar question.
Or will broader limits on raw materials and specialized labor act as a hard ceiling, capping their growth no matter how much money they spend? It is a high-stakes race against the supply chain, and Nokia is betting its balance sheet that it can win.
It's a massive bet.
Hmm.
And the execution over the next few quarters, as those U.S. fabs come online, is going to be the ultimate proving ground.
Well, that's all for today's deep dive. Be sure to follow the show for daily, no-nonsense earnings coverage, keeping you informed on the numbers that actually matter. See you next time.